Good morning, everybody. Thank you for joining me today. My name is Amber Hines, and we're going to be talking today about how to handle previous gifting in a married couple crisis case. I want to say Happy New Year to everybody, and I hope 2021 is off to a great start for everybody on this call. If you have questions for me throughout today's webinar, feel free to type those into the questions bar of the GoToWebinar task board. And then also, if you are interested in a copy of the handouts from today's webinar, you can also find those in the handout portion of the GoToWebinar dashboard. Again, my name is Amber Hines. I have been working with elder law and estate planning attorneys for the last 15 plus years on Medicaid compliant annuity strategies. I am insurance licensed in all states, and I hold a Series 65 license with FINRA. And I created Ashbur to assist attorneys and advisors with pre-planning solutions as well as crisis Medicaid planning solutions. How we can help you and your clients. You're seeing a list here of some of the services that we offer. So we offer complimentary case analysis, which means that if we receive information on your clients, such as their assets, income, their ages, or dates of birth, we can help in determining the optimal annuity amount, the term of the annuity, and which assets the clients could consider annuitizing. And we're generally looking at whether the assets in your states, as far as IRA accounts or non-IRA accounts, are going to be exempt, and also looking at the tax status of the assets to determine what makes sense to annuitize versus how many assets the client is able to keep as the resource allowance. We offer assistance from the beginning to the end of a case. So we provide quotes for your client. We provide assistance with the actual funding of the Medicaid compliant annuity. So if your clients have retirement accounts that you're looking to convert into a Medicaid compliant income stream, we can assist with the actual funding. And then if your client were to pass away during the term of the annuity contract, we also assist with the death claim process if that would become necessary as well. We only work with A-rated insurance carriers. So when we are looking to place the Medicaid compliant annuity, we would be looking to highly rated insurance carriers to actually accept that business on behalf of the client. And we also offer top-notch customer service. So if you contact us, we usually get back to you within the same day, if not that same day, within 24 hours. So when we talk about the crisis Medicaid planning goals, when we are planning for, in this case, a married couple, what we're trying to do is convert countable resources or assets into non-countable or exempt resources in the most cost-effective, tax-efficient way. We're also trying to obtain Medicaid eligibility as quickly as possible without any penalty or private pay period, which we're going to talk more about. And then finally, we're also looking to minimize or avoid estate recovery as well. When we consider the income and the asset limitations for a married couple, the institutionalized spouse is able to, from an income standpoint, their income must be less than their cost of care. This usually is not hard to do based on the cost of care being significantly higher than what most clients' Social Security or if they have a pension income would be. There is an exception to states that have an income cap. So if your client that is institutionalized has more income than $2,382, which is the 2021 Medicaid number for an income cap, then we would have to set up a qualified income trust or a Miller trust in order for that institutionalized spouse to meet the income requirements and still be eligible for Medicaid. The community spouse, on the other hand, is entitled to an unlimited amount of monthly income. And if the community spouse does not have enough of his or her own monthly income to meet their minimum monthly maintenance needs allowance, then they will actually receive part of the institutionalized spouse's income on a monthly basis as well, so that the community spouse is able to meet their expenses. The asset limitations for a married couple, on the other hand, an institutionalized spouse is able to keep $2,000 of liquid resources in most states. This is going to vary slightly depending on the state. And then a community spouse is entitled to keep 1/2 of the couple's total resources up to a maximum of $130,380. This is the updated 2021 number, the 130,380, but this does vary slightly depending on your state as well. Other resources that Medicaid is going to consider to be protected or exempt assets include a home, automobile, household goods and personal property, an irrevocable funeral trust, or a prepaid burial. And then some states are going to exempt an IRA or a retirement account for the institutionalized spouse and or the community spouse. So it does vary depending on your state as far as whether the IRA is going to be protected, and it does differ between the institutionalized spouse and the community spouse. So a state like Wisconsin and Pennsylvania, they are going to exempt the community spouse's retirement account, but they count the institutionalized spouse's retirement account. If your Medicaid clients have excess assets, we generally look at developing a Medicaid eligibility plan, which can include increasing or improving non-countable assets such as the home, buying a new car, any personal items that the Medicaid applicant or the community spouse would need. We would recommend that those are bought in order to spend down some of the excess resources. Also, a client can consider purchasing prepaid burial policies, paying off credit cards, mortgages, and other debt. And then if there's still assets that are left over after these items have been purchased, we can consider purchasing a Medicaid compliant annuity that would comply with the Deficit Reduction Act of 2005. The language that must be contained within a properly structured immediate annuity or a DRA Medicaid compliant annuity includes irrevocable, non-assignable, actuarially sound, equal payments, and the state must be named as a remainder death beneficiary on the annuity contract. So a Medicaid compliant annuity is always going to be an immediate annuity. It can never be a deferred annuity, because a deferred annuity is going to be considered an asset for Medicaid qualification purposes because there is cash surrender value within a deferred annuity. An immediate annuity, on the other hand, is strictly an income stream. And so when we're looking at the 5 requirements on the screen, the irrevocable language that must be contained within an immediate annuity is that we can't change any aspect of the annuity contract after it would be purchased. So this means that we have to make the income stream, the payee, the owner of the contract, the beneficiary, every aspect of the annuity must be completely irrevocable. Also, the non-assignable language means that we can't assign the annuity contract to a company like JG Wentworth or companies on the secondary annuity market that would normally purchase structured settlements or immediate annuity contracts. The actuarially sound requirement means that the annuity must return the full investment amount within the person's Medicaid life expectancy. We generally, in most states, can do an annuity that would be shorter than the person's life expectancy and still meet that actuarially sound requirement. Equal payments means that we can't have any type of balloon annuity structure when we're looking at a DRA Medicaid compliant annuity, because the payments must be equal. And in most states, it must be a monthly payment, but some states do allow for annual payments. And then finally, the state being named as a beneficiary, there's an asterisk there because there are some exceptions to this requirement that some states do not require that the state be named as a beneficiary, and some states will allow the state to be a secondary beneficiary after a spouse. So first, we're going to look at a case study that does not involve any previous gifting at all. So we're looking in this case to achieve immediate Medicaid eligibility by using an immediate annuity that would comply with the Deficit Reduction Act. In this case, we're looking at a scenario that does not have any gifting involved, and one spouse is in a nursing home and the other spouse is remaining in the community or at home. When we look at the goals for when we're planning for a married couple, when we have one spouse that is institutionalized and the other spouse is considered a community spouse, we're looking to obtain immediate Medicaid eligibility without any type of penalty period or private pay period for the institutionalized spouse. And we're going to achieve that by converting excess resources into an income stream. We also are looking to provide the community spouse with peace of mind that he or she would have sufficient income and resources so that they're able to maintain their lifestyle within the community. We're going to look at a married couple scenario with Roger and Nancy. And Roger is 80 years old. He's been diagnosed with dementia and has been in a nursing home as of the 1st of this year, January 1st of 2021. He has monthly income of $2,000 per month, and he's currently spending $10,000 per month on his nursing home costs. Nancy is Roger's wife, and she is 75 years of age. She is the community spouse, and she has monthly income of $1,000 per month. The couple together has a home, a car, and $400,000 of non-IRA bank accounts. And Roger and Nancy plan to apply for Medicaid as of February 1st of this year. So first, we're going to calculate what the spend down amount would be based on the updated 2021 Medicaid numbers. So Roger, as the institutionalized spouse, is able to keep his personal property, a prepaid funeral policy, and $2,000 of the $400,000 in cash assets. Nancy, as the community spouse, is able to keep the home, a car, her prepaid burial policy, her personal property, and then $130,380 of the $400,000 in cash assets. So when we deduct $132,380 from the $400,000 in cash assets, we see that their spend down amount, or the excess resource amount in this case, is going to be $267,620. We can eliminate the excess resources or the spend down amount by purchasing a Medicaid compliant annuity for Nancy. Nancy is the community spouse, so she's going to be the annuity owner, the annuitant, and the payee. And we would recommend that the annuity is purchased in this case in January of this year, prior to applying for Medicaid. So if we look at the single premium of $267,620, and we structured the annuity over a 60-month time frame, the monthly payout to Nancy on a monthly basis is going to be $4,500 per month. We arrive at the total payout by multiplying the 60-month time frame by the monthly payment of $4,500 to arrive at the total payout of $270 over the 60-month time frame. With Nancy being 75 years of age, she actually has a remaining life expectancy of almost 13 years or 155 months. So in this case, 155 months is going to be the longest annuity term that we could structure for Nancy, but we can always shorten the annuity term as long as we are not working in a state that has an actuarially sound requirement that is more restrictive than what the federal rules would be. So in this case, we shorten the term to a 60-month time frame in order to accommodate the fact that Nancy had a larger income need than what would have been achieved by structuring the annuity over her full life expectancy of 155 months. We're going to first calculate Nancy's monthly income to determine if she is going to receive a shifting of income from Roger on a monthly basis. In this case, if we add the Medicaid compliant annuity payment of $4,500 to her Social Security income of $1,000, we see that her total monthly income is going to be $5,500. The current 2021 monthly maintenance needs allowance, the maximum amount is $3,259.50, with Nancy's monthly income of $5,500 being more than what the monthly maintenance needs allowance is. We know that Nancy does not have a shortfall on a monthly basis, so she is not going to receive any of Roger's monthly income in order for her to meet the MIMNA requirement. So when we're calculating what Roger's copay to the facility is going to be, we have his Social Security income at $2,000, and we subtract out a shifting of income if there was going to be a shift over to Nancy. And then we also subtract out Roger's monthly personal needs allowance at $50 per month. So his copay to the facility on a monthly basis is going to be $1,950 each month. The economic results of structuring the annuity over a 60-month time frame, the couple was expected to pay $10,000 per month for Roger's care. We were able to reduce the copay down to $1,950 per month, so that the couple immediately experienced monthly savings of $8,050 on a monthly basis, resulting in Medicaid eligibility starting as of February 1st of 2021. The advantages of the Medicaid compliant annuity plan include obtaining immediate Medicaid eligibility for Roger. So with the annuity being purchased in January of this year and there not being any previous gifting or anything, in this case, we were able to obtain immediate Medicaid eligibility for Roger without any penalty period, so that the state would start paying for his care as of February 1st of 21. We also created sufficient monthly income for Nancy through the use of the Medicaid compliant annuities so that she's able to continue living in the community. The annuity in this case does not cause a penalty period or an uncompensated transfer because we included all of the necessary language that would be required in order for the annuity to strictly be considered an income stream and not an improper transfer that would take place if we did not have all of this language that would be contained within the annuity contract. The potential disadvantages of the Medicaid compliant annuity would be if Nancy, as the annuity owner and the annuitant, were to pass away during the 60-month time frame of the annuity, the state Medicaid agency would be the primary beneficiary and they would be entitled to a payback upon Nancy passing away. So that is going to reduce the amount that the children or the contingent beneficiaries would receive if Nancy predeceases the 60-month time frame. So in order to reduce the likelihood that Nancy would predecease the annuity term, we could consider depending on the annuity amount and what Nancy's health is like, we could consider structuring the annuity over even a shorter time frame than a 60-month period. Now we're going to move on to a previous gifting scenario. So if we look at a fact change to the initial case facts that we just went through, and we assume that while reviewing the client's financial statements, you discover that Roger and Nancy have made transfers. These are possible gifts of $20,000 over the past 5 years. So first we need to determine if the transfers will be treated as gifts or a penalized transfer. There's a difference between a gift and a compensated transfer. So a gift is going to be a transfer of assets for less than fair market value, or an uncompensated transfer. A gift during the look back period does result in a penalty or a private pay period. Whereas if we look at a compensated transfer, this is a transfer of assets by a Medicaid applicant for which the applicant received fair market value. A compensated transfer is not going to result in a penalty period. The current look back period is 60 months in all states other than California. California currently has a 30-month look back. So all states that have adopted the Deficit Reduction Act of 2005 have a 60-month look back, and only gifts that are made during the look back period are going to be counted or penalized and reported to Medicaid. So the look back period is the amount of time that Medicaid can examine an applicant's finances in order to determine if there were any uncompensated transfers that were made, which is why generally the Medicaid application is going to ask if a client has made any gifts or transfers within the last 5-year period, because that is the current look back period for Medicaid in all states other than California. Not all transfers will be penalized by Medicaid. So some transfers that are made for the purpose other than qualifying for Medicaid will not necessarily cause a penalty period or a private pay period. Some examples can include a consistent pattern of giving to a place of worship. So if you're working with clients that have been consistently giving to a certain nonprofit or a certain church, then you may be able to prove that this was a pattern prior to the person needing to qualify for Medicaid, and therefore it should not be a penalized transfer resulting in a penalty period. Also, sometimes gifts that are made well in advance of the individual needing care will also be something that a caseworker will not necessarily penalize for the client. And then every state is going to have an amount of money that is considered to be a nominal or small gift amounts that are not penalized. Usually it's an amount under either $500, $1,000, or $1,200 that the state will not penalize small or nominal gifts. So it's important to know what your state is going to consider to be a penalized transfer versus something that is not going to result in a penalty period. This exception may be difficult to prove, so it's not necessarily a slam dunk as far as just going in and making a Medicaid application and saying that a client made several transfers that were for the purpose other than qualifying for Medicaid. Depending on your state, this may be more or less difficult to prove in order to avoid any type of penalty period. So if we are successful in proving that the $20,000 of transfers are not penalized and the Medicaid compliant annuity is purchased, Roger is going to be eligible for Medicaid as of February 1st of 2021. However, if we're unsuccessful in proving that the $20,000 in gifts were made for purposes other than qualifying for Medicaid, then we need to determine what the penalty period is going to be as a result of making these gifts. Calculating the penalty period is going to be the number of months a Medicaid applicant is ineligible for Medicaid because of an uncompensated transfer or a gift that was made during the 5-year look-back period. When we look at the formula for calculating the penalty period, we're going to add up the total gifts within the 5-year look-back period, and we're going to divide that by the divestment penalty divisor. This is a state-specific number in your state, and that is going to equal what the penalty period is for that specific client in your state. The divestment penalty divisor is a number that is published by your state Medicaid department, and this is supposed to represent the average cost of 1 month of nursing home in your state. So for example, if we look at Pennsylvania's divisor, their current number is $11,099 per month, whereas a state like Arkansas, the divisor is currently $5,871. So this is very much dependent on the area of the country that you are located in as far as what the divisor will be in your state. If you have questions on that, feel free to reach out to me. So in this case, if we assume that Roger resides in Pennsylvania and he plans to apply for Medicaid eligibility starting February 1st of 2021, if we calculate the penalty based on Roger making gifts of $20,000 and Pennsylvania's divisor being $11,099, the resulting penalty period is going to be 1.8 months. We arrived at that by dividing the gift amount of $20,000 by the current divisor of $11,099, and we calculated that the penalty is 1.8 months. The solutions to deal with previous gifts in this case are going to include simply accepting the penalty period of 1.8 months. Also, another option is going to be returning the gift. And then finally, the last option would be to use a promissory note. So option number one, if we accept the penalty period, then we're basically not going to cure or deal with the previous gifts. So instead of Medicaid eligibility starting as of February 1st of 2021, Roger is going to be responsible to privately pay for the month of February and part of March, representing this 1.8 month penalty period, so that Medicaid eligibility, instead of that starting February 1st, it's now going to start March 25th of 2021. We calculate the actual penalty period down to the actual day because that penalty period is not going to be rounded down like it previously was before the Deficit Reduction Act. So we determined that Roger is going to be eligible for Medicaid as of March 25th of 2021. So many people are going to ask where the funds are going to come from in order to privately pay for February and then part of the 25 days in March that would need to be paid for privately. The answer in this case would be that it's likely going to come from Nancy's Medicaid compliant annuity payments, or it would come from her community spouse resource allowance of $130,380 that she's going to keep in assets. If we accept the penalty period, Roger and Nancy's Medicaid compliant annuity plan is going to remain exactly the same. Medicaid eligibility is going to be delayed until March 25th of 2021. And like I said, the private pay costs are likely going to come from Nancy's Medicaid compliant annuity payments of $4,500 per month, or her community spouse resource allowance of $130,380. If we recall that Roger's monthly nursing home bill was costing him $10,000 per month, and he has monthly income of $2,000, he is short on a monthly basis of $8,000 per month. So if we look at the original community spouse resource allowance that Nancy was going to keep of $130,380, and we know after taking into consideration the $2,000 that Roger has in monthly income, we see that 1.8 months of penalty is going to result in around $14,400 that would need to be covered on Nancy's side of the equation. So the amount that she's going to have left after they privately pay until March 25th is going to be $115,980. The advantages of simply accepting the penalty period of 1.8 months is that it's a pretty simple strategy. We're only employing one planning technique, the Medicaid compliant annuity. Almost all states are going to recognize the Medicaid compliant annuity planning for a community spouse. And then Roger is going to become eligible for Medicaid in the month of March. The disadvantages of simply accepting the penalty is going to be obviously that we're not obtaining immediate Medicaid eligibility for Roger, and we realize that the private pay costs are going to have to come from the annuity payments that Nancy receives or from the community spouse resource allowance. The second option would be to return the gift. So in order to avoid the 1.8 month penalty period, the $20,000 could be returned to Nancy. If the gift is fully returned or cured, a private pay or a penalty period is no longer going to exist. The Medicaid compliant annuity amount is going to be increased by the $20,000 gift that would be returned to Roger and Nancy. The original Medicaid compliant annuity amount was $267,620. And so if we look at the previous gift being returned to Nancy, the annuity amount is going to increase by the gifts that are returned. If you recall that the original resource amount that the couple had was $400,000, we would then add in the returned gift amount of $20,000 and also subtract out the protected resource amount of $132,380, because the couple is still going to be capped at the $132,380. So we realize that the annuity amount in this case is going to increase by the $20,000, so that the new annuity amount is $287,620. This slide is just showing you how much the annuity is going to increase based on $20,000 more going into the contract. So initially, the annuity was going to generate around $4,500 per month. In this case, it is now going to increase to $4,850 per month, and the total payout is going to increase slightly based on more money going into the annuity contract. By returning the $20,000 and increasing the annuity amount, we are obtaining immediate Medicaid eligibility for Roger as of February 1st of 21. So in this case, because the gifts have been returned and the couple has met the resource limitations, in this case, we're able to achieve Medicaid eligibility immediately as opposed to having to private pay until March 25th. One thing to be aware of is if the full gift amount of $20,000 cannot be returned to Roger and Nancy prior to purchasing the Medicaid compliant annuity, and there's plans for the gift to be returned after the Medicaid application is made, it's important to find out if your state recognizes partial cures in order to reduce the penalty period. So some states do not allow for the gift to be returned after the Medicaid application is made in order to cure a portion of the penalty period, but they would require that the full amount is returned to the Medicaid applicant in order for the penalty period to be reduced. So if you have questions about what your individual state does, feel free to ask us. The advantages of returning the gift, still we see that this is a pretty simple strategy because we only have one planning tool, the Medicaid compliant annuity, that's being employed in this case. Also, most states are going to recognize the Medicaid compliant annuity plan for community spouse. We were able to obtain immediate Medicaid eligibility for Roger. The disadvantages of returning the gift is this obviously may not be an option in your case, depending on who the gifts were given to and how long ago the gifts were made. So there are some circumstances that the gift can't be returned to the Medicaid applicant or the spouse. And in that case, you're just going to have to basically accept the penalty period and realize that the family will have to privately pay during the 1.8 month penalty period because we're not able to return the gifts to the Medicaid applicant or the spouse. And then finally, the last option would be to use a promissory note. So assuming Roger and Nancy want to avoid the 1.8 month divestment penalty period and immediately qualify for Medicaid benefits as of February 1st of 21, the $20,000 in gifts could be recharacterized as a loan or a promissory note. Generally, this is going to be done between the giftee and the community spouse in order for the promissory note to provide income only to the community spouse. In order for the promissory note to meet the Medicaid eligibility criteria, the promissory note has very similar language to a Medicaid compliant annuity contract, meaning that the requirements that you're seeing on the screen here are almost identical to the annuity contract. The promissory note must be actuarially sound. It must provide equal payments during the loan amount. There cannot be any deferral or balloon payments. It cannot prohibits cancellation on death. And then also, in order for the promissory note to be non-countable, it must be irrevocable and non-assignable, similar to a DRA compliant annuity. If we look at how to structure the promissory note, the loan could be structured for as long as Nancy's Medicaid life expectancy of 155 months based on her age of 75, or we could shorten the promissory note to something less than 155 months. If we were to base the loan on the full life expectancy of Nancy at 155 months, and you divide the $20,000 in gifts, the monthly payment on the note is going to be around $130 per month. And the note would be structured so that the payments are going directly to Nancy, the community spouse, who can have unlimited monthly income. As a result of implementing the Medicaid compliant annuity and the promissory note plan, Roger would immediately be eligible for Medicaid as of February 1st of 21. The Medicaid compliant annuity that we originally talked about is going to remain exactly the same at $267,000. We still are structuring that over a 60-month time frame and creating monthly income for Nancy at $4,500 per month. So the impact of doing the annuity and the promissory note is that Roger's monthly income is not going to be affected by either the note or the annuity. His monthly income is going to remain at $2,000. This was his Social Security income. And then when we add in the promissory note payment to Nancy's monthly income, her income is going to increase from $5,500 up to $5,630 per month. Her monthly maintenance needs allowance remains at $3,259.50. So Roger's copay to the facility is going to equal all of his income at $2,000 less his personal needs allowance at $50 per month. So it remains at $1,950. And we were able to achieve immediate Medicaid eligibility as of February 1st of 21. The income calculations we do with the exact same way, except for we're going to add in the promissory note payment of $130 on Nancy's side of the equation. So her income is $5,630 per month, which is more than the monthly maintenance needs allowance at $3,259. So she's not going to receive any of Roger's monthly income again. So his copay to the facility equals the $1,950, just like it did in the first scenario where we did not have any gifting. One item of caution is that many states do not recognize promissory notes as a planning tool in order to do Medicaid planning or in order to cure a gift. So you'll want to know what your state's stance is on a promissory note and whether that can actually be used in order to cure a previous gift or transfer. The advantages of the promissory note is that Roger is immediately going to be eligible for Medicaid without any type of penalty period or private pay period. Almost all states are going to recognize the annuity planning that we talked about. And one advantage of the promissory note is that it can be structured so that the payments are affordable for the giftee to pay back. So in our example, we structured the promissory note over the full life expectancy of Nancy at 155 months, which resulted in pretty nominal monthly payments of $130 per month. So we have flexibility as far as how the note is structured so that it is affordable for the giftee to be able to return that money on a monthly basis. Some of the disadvantages of the promissory note is that this may not be an option if promissory notes are not permitted in your state. And then also we are employing more complex planning tools because we're doing an annuity and a promissory note at the same time. So it may become a little bit more confusing for the family to understand the different moving parts of all the planning in order to achieve immediate Medicaid eligibility. Some of the factors to consider when you're looking at which option to choose. Obviously, one of the most important things is whether your state recognizes each of the strategies as a planning technique. If your state does not recognize a promissory note, then we know that option number 3 is not going to even be on the table as a potential solution. Also, we look at the amount of previous gifts that a client has made. So a $200,000 gift that results in an 18-month penalty is going to be a lot different than a $20,000 gift that results in a 1.8-month penalty. We need to calculate how long the penalty period is going to be and figure out if any of the gifts are actually curable or can be returned to the Medicaid applicant or the spouse in order to reduce that penalty or potentially eliminate the penalty period. Also, we would want to consider the health of both spouses. So if we're unsure how long the Medicaid applicant is going to live, we would take that into consideration before we would actually make a Medicaid application and incur any type of penalty period resulting from previous gifts. And then also the amount of resources that the couple has in order to privately pay. So it may be a scenario if a client doesn't have sufficient resources in order to privately pay during a penalty period, that the only option is for the gifts to actually be returned in order for there to not be a penalty period so that Medicaid will start paying immediately. And it does look like we have some questions here that I will try to answer. I will say that before I answer questions, the February webinar that we're doing is related to both spouses being in a facility and the planning techniques that we can use when we have two spouses that are going to be in a facility. So look for an email related to the February webinar. Okay, somebody is asking about the penalty or the penalized gift amount in Illinois. So that's going to be dependent on whether the client is in a skilled nursing facility or is in a supportive living facility. In a skilled nursing facility, we're going to use the actual private pay cost of the facility, whereas a supportive living facility, the current rate is around $181 per day for calculating a penalty period. Okay, somebody is asking if eligibility, this is related to accepting the penalty period. If eligibility is February 1st and the penalty is deducted from the $130,380, wouldn't eligibility be February 1st and then the CSRA amount lowered? Yes, the Medicaid eligibility would still go into the otherwise eligible criteria, or the penalty period is going to start as of February 1st, and then the resulting community spouse resource allowance is going to be lowered after we privately pay for February and part of March. And somebody is asking about a previous gift that is less than 1 month's penalty divisor. They're asking about like $100 gift. In that case, I would be looking at what your state considers to be a nominal or a non-countable gift to determine if a penalty period is even going to result in such a small gift amount. But generally, the penalty period is not going to be rounded down. It's going to be the actual number of days that the penalty would be. But with a $100 gift and a divisor being around $300 a day, there likely is not going to be a penalty in that case at all. Okay, there's other state-specific questions here, which I will reach out directly to the individuals to answer depending on your state. So I want to thank everybody for being part of today's webinar. And if you have any questions for me, feel free to reach out either by phone or email. And thanks again for being part of today's talk. Take care.